Now, quickly, let us look at what we call what? The format of trading account and statement of comprehensive income for the year ended. Now, look at this. This is for the year ended. That is what? For a period. Year ended, the period can run from January to what? To December. 12 months. Periodicity concept says that we need to be able to determine the performance or measure the performance of a business or of an entity within a particular period, which is periodicity. When can we measure? We cannot, because there's a growing concern that the business is expected to exist for a foreseeable future. That if there's nothing that will curtail the operation of the business is expected to exist for only God knows when. It can be for 1 million years, can outlive the owner. But the business world cannot wait till the end of eternity to determine or to know or to measure the performance of this business. The reason why they need to come with what? A particular period where we can measure performance. And this case is usually what? 12 months. And the account we are preparing for what? For the year ended. When we are talking about trading and statement of comprehensive income for the year ended, then you write the calendar, maybe 30th of September or 31st of October, whatever, 12 calendar months. Now, look at what we have. You can either use, we have what we call vertical formats of this or horizontal. They call horizontal, vertical, or T format. Horizontal or T format. This is the T format. Now, we start with what? On the debit side. And this is the what? The credit side. You start with opening stock or opening inventory. When you hear opening stock or inventory, we are talking about the same thing. Stock and inventory are the same. Opening inventory or stock. Add purchases to what you have opened with. You need to add stock to it. Add purchases. Let's return outward. Now, return outward is talking about part of what you purchase here. You return parts back to the supplier. Maybe because they are bad or they are not good or the quality is not to standard. You need to return. That you have to let's take it out. Anytime you see anything in jackets or in bracket is what? Less. Let's return outwards. Then add carriage inward. What is carriage inward? Carriage inward is the expense or money paid to bring the goods in from your supplier. It's an expense, what you pay. They will form part of what you bought. They will form part of the total cost. When we talk about cost in accounting, we are talking about every money you spend in bringing that particular item to its present location and condition. Every penny spent in bringing it to its present location and condition. Whatever you are paid to bring that goods that you have purchased here to your store, to its present location or condition, is part of what? Is what we call carriage inward. You have to add it to form the total cost because it is a relevant cost. You will not need to spend to bring any goods in if you have not gone to buy goods. You have not gone to purchase. There is no need in carrying what? Carriage inward. Or if there's not going to be any carriage inward, that means you bought it yourself, you brought it in yourself. But you had carriage inward where you have carriage inward. By the time you do your purchase, opening stock, you add your purchase to it, you take away your return outward, and you add your carriage inward. What you have down here is what we call your cost of goods available for sale, COGAS. Cost of goods available for sale. This is the total cost or value of the goods you have to sell. Less closing inventory or closing stock. Take away closing stock from it because you have not sold it. By the time you do this, what you have left is what we call what? Cost of goods sold. The cost of goods that you sell. The cost of goods are what? That you sell. Now, you add wages. This wages is what we call what? Direct what? Expenses. For people in the production, whatever, because it's going to form part, the cost of whatever you are going to sell. Because they work directly, whatever you pay them is what we call wages, direct wages. It's going to form part of what? The goods. Now, come to the credit side. You have your sales or turnover. Sales and turnover are the same. Your sales figure, then less your what? Return inwards. What you have sold out and what they will return, part of what you sold out and the customer have returned, you take away that return to get what we call what? Your net sales. This is your net sales. You compare your net sales to your what? To your total what? Cost of sales. This plus this. So whatever you have here, when you compare your total what? Net sales and the cost of sales, everything we are calculating here is just what? Cost of sales. The cost of what you sold. For instance, if your cost of sales, or every item here is talking about your cost of sales. If the cost of sales is what? It costs you 70 naira to produce a pen and you sold it for 100 naira. That means you are making what? A profit. Something that costs 70 to produce a pen, you are now selling it for 100 naira. You have made a margin of 30 naira. This will now be your what? Gross profit. The 30 naira will be your gross profit. By the time you bring it down, this will be what? 100, and this will be what? 100. That is what? Your cost of sales. That means when cost of sale is what? Is less than your sales value. The difference is what? Gross profit. And if your cost of sales is greater than your sales, the difference is what we call what? Gross loss. Please note, the essence of preparing your trading account and statement of comprehensive income is to determine what? Your gross profit. Gross profit is the profit made in buying and selling. Your trading, when you are trading, buying and selling, the profit made is gross. That means before you take away all other business expenses, the gross profit is the essence of preparing your trading and comprehensive of income statement. The essence is to arrive at what we call gross profit. This is the reason we are preparing this. Once you have arrived at your gross profit, as a businessman, do not rejoice yet, because all other business expenses are still going to be taken into account to know whether you have really made profit. Because we are not talking about all other expenses like electricity, like maintenance, repairs, rents, salaries. We are talking about motor vehicle running expenses, petrol, diesel, all other business expenses are yet to be taken care of, because trading account and statement of comprehensive income is only talking about gross profit. Look at what we have here. Look at this. Don't forget, this is the continuation of your trading and statement of comprehensive income account for the year ended. You don't need to write additional another heading, because this is the continuation. Now, the beginning of your statement of comprehensive income is what? The gross profit or gross loss that you made in your trading account. Trading account excess is what? To get gross profit. Now we have gotten gross profit. You need to add other incomes to it. Income like interest received, rent received, commission received. Then decrease in provision for bad or doubtful debt that we explain. We said that one of the adjustments to final account was provision for doubtful debts. And we said if there's any decrease in provision, that becomes an income. That means the provision you have made is more than what you ought to have made. The difference is an income. Why? If the provision you have made what increase, that means not up to what you ought to have made. You have made the provisions of 50. In reality, the money now got to 70. That means there is an increase in provision. That would be an expense. When you add all other income to it, then take away all other what business expenses like salaries, rent and rates, carriage outward. What the carriage outward? Carriage inward has to do with when you buy goods from your supplier. Carriage outward means the expenses incurred in selling your goods, taking your goods to your customers. The other one, bringing the goods into your store. This one, taking the goods, selling after production to your customers. It's an expense, carriage outward. Depreciation, the writing down of the value of your asset over its estimated or useful life. The one consumed for the year, which is an expense. You need to make adjustment for it, account for it. Printing and stationery, discount allowed is an expense. Why discount received is part of what? It's part of your income that you account for. Discount allowed is an expense. Repairs, telephone expenses, motor expenses, loan interest, advertising, all expenses that you can think of in business. General expenses, office expenses, they are what? All the expenses that you must bring into account. Those ones consumed for that particular year. Remember, you have to make adjustment for what? Accrued expenses, accrued income, prepaid expenses or prepaid income. Because if there's any accrued expense or prepaid expense here, you need to adjust for it. So the figure you are given in trial balance, if for instance in trial balance the figure you are given for rent and rent is what? 300,000 naira. And additional information is telling you that there is an accrued rent. That means outstanding, owing. The rent that you are owing, that you have not paid, there is an accrued rent of what? 100,000 again. That means this is owing. It's a liability. Now the total rent and rate that will be in your P&L will be what? The current one in your trial balance and the additional 100 that you are informed about, which means 400,000 naira. All other expenses you can think of, you need to bring them into account. Now, that is for what? Accrued rents and rates. Now, if you also have what we call accrued what? Telephone expenses or prepaid expenses, telephone expenses. For instance, maybe one of the you do postpaid, one of the mobile telephone what operators, you have already paid them in advance. That is advance for telephone expenses. You have paid them advance, and your trial balance, the total telephone expenses you have is, for instance, 50,000 naira. You are now giving additional information that out of this 15,000 naira, you have paid what? Advance of what? 40,000. That means in this 50,000, there is an element of what? Advance, worth 40,000. That means the actual telephone expenses that belongs to the current year is what? The difference between the two, which is the 10,000. You need to make adjustment because you only want to capture the exact amount consumed for that accounting year for the financial statement, period profit or loss account to be what? Accurate, complete. We need to capture the exact expense for that year. Now, the reason why we are preparing profit or loss account or statement of comprehensive income is to determine your what? Your net profit coming from gross profit in trading accounts. You have added all your incomes together. You are now comparing all your income what? To all the expenses. If expenses is greater than what? Income, the result is what? Net loss. Now, if your expenses is lower than your income, the difference is what we call net profit. So if it is net loss, then it will be this side. But because it is net profit, that is why we have it here, the balancing figure. This is to balance the difference between your expense side and your what? Income side. Now, the trading account, out of all the trading account, only gross profit followed us into statement of comprehensive income. When we get to statement of financial position, which is the balance sheet, it is the net profit that we need. Look at the balance sheet. Or we call this statement of financial position assets. This is talking about at a particular point. This is at particular point in time. Point in time. Because something can change, we can give you an information now and it can change in the next 10 minutes. Say, as at the time you gave me the information, as at the time we prepared this financial position, this is the what? The value. Now look at non-current asset, or they call it fixed asset. They are fixed because they are going to spend more than one accounting year. We are going to use them for more than one accounting year. Or they are called what? Fixed assets. Land and building. The cost, this will be given in the trial balance. The depreciation here is talking about what? If there's any depreciation you are bringing, this will be what? Previous depreciation plus current year depreciation. The current year depreciation is talking about the depreciation in your what? P&L. While the previous, or they call it accumulated depreciation. In some texts, they call it provision for depreciation. So this will be your what? Trial balance. That means the depreciation that be accumulating for the previous years, you need to bring them together with the current year, which will be in your P&L. When you add it together, take it away from the cost, because historical concept says all these fixed assets should be what? Brought into the book at what? At cost. Bring the items here, the depreciation. When you take it away, the net book value will be what? The difference. Do the same for plant and machinery, for furniture and fittings, to motor vehicle. What you are interested in to know the value of our asset is what? The total of the net book value. You can total this and close this, but what? The total of the net book value. Then we have what we call a long-term investment. Add it to it. The current assets are called what? Current because they have maximum of 1 year. We are using them not more than 1 year. Your inventory will be turned over more than once in a year. They are not like fixed assets that can spend 5, 6, 10 years. But these, they are current. Your inventory, which are your what? Your stocks. Your trade what? Receivables, which are your what? Your debtors. What is that? They make provision for less provision for bad debt. Don't forget we said it. For us not to overstate our debtors value, our trade receivables, we make provision. So we have to less the provision to show the true value of our what? Of our trade receivables. Once we have done that, we have what? Our short-term investment. Prepayment, I told you, anything you have paid in advance is what? It's an asset. It's a current asset. The rent you have paid in advance is an asset. Accrued income that is accrued to you, income that you are supposed to have received. You have earned it, but you have not received it. That's accrued. You know, we use accrual concept. Accrual concept is telling you that take care of everything that you have earned but not received. You have earned your salary. Each day you go to work, you have earned the salary. But it will not become due, or you are not going to receive it until the last working day of the month. So you have earned, that is accrued income. It's an asset, current asset. So if you decide to leave before the payment date, if you decide to leave before the last working day of the month, the ones you have earned that you have not received, you have to be paid. It's an asset, current asset. Accrued what? Income. Salary earned but not paid. You have earned but you have not received. Then your cash, your bank balance is also what? Current asset. Add all your fixed assets to your current asset, whatever you have. Now, you need to compare this to your debit side. Your debit side is talking about the what? How you finance your business. For instance, we have capital. Do you introduce any additional capital into the business? Add it up. The net profit, add. Now, if it is loss that we have here, for instance, net loss in your statement of comprehensive income, that means you take away your what? Your net loss. You take away net loss, but you add what? Net profit, as we have in this question. So it depends on the question. If you have a net profit, add to your capital, take away what? Net loss. Now, drawings is money taken away from the business for personal use. You take it away because it's going to affect what? The equity of the owner. So you take away what? Your drawings, whatever value we have. Now you compare, you add it onto what? Your liabilities, your long-term liabilities, your bank loan is a liability. Current liability are liability that are payable within 1 year. Your trade creditors, accrued expenses that you have enjoyed but you have not what? Paid. Is the opposite of accrued income. Accrued expenses, you have enjoyed it but you have not paid. You have been using electricity from the beginning of the month, but your bill will be served at the end of the month. That means they will start accruing what you have been using. So it's a liability. Accrued expenses. Income received in advance. If you receive income in advance, it's a liability. You are paid income for a particular month that you have not entered into. You are paid 2 months income and you have not worked for the 2 months. So it's a liability because if you fail to work for the second month, you are going to refund. It's a liability. Income received in advance. Then we have bank overdraft. It's a liability. If you add all your liabilities to your capital, it must be equal to the total of your what? Asset side. Your capital figure, add it to your liabilities. Whatever you have compared to the total of your assets must be equal for us to have a balanced balance sheet. That is the same thing we are talking about when we talk about our accounting equation, which says what? Equation 1 says assets equal to capital. That's equation 1. Equation 2 says assets equal to capital plus what? Liability. That's equation 2. We are saying compare my assets here, this side A, compare it what? To the left hand side, debit side, which comprises your capital and what? And liability. At this junction, we want to say thank you for your time. Thank you for choosing Prestige Tutors. Please subscribe to our YouTube channel. Click this subscription button so that you can get notifications anytime we post our videos. Thank you. Next time we'll continue to look at other concepts in accounting. Thank you for your time.